Hello, everyone, and thanks for joining us at Smart Money Results. We have a very special guest for you today, best-selling author, investor, entrepreneur, and real estate expert, Marco Santarelli. He is the founder of Norada Real Estate Investments, and he is the host of the Passive Real Estate Investing Show. What makes Mr. Santarelli stand out is that he has a true passion for helping everyday folks achieve financial independence. Best of all, he has a skill and acumen to guide you through both bull and bear markets. Marco, thank you so much for being with us at Smart Money Results.
Hey, it's my pleasure, Josh. I'm really happy to be here, and hopefully I can provide a lot of value for your audience.
Awesome. What first question involves the distinct nature of real estate investing. When most people think about investing, they usually think about stocks, bonds, gold, even Bitcoin. What makes real estate a relevant choice today?
Well, that's a good question, and one that could be very in-depth. You see, my understanding from you is that your audience is primarily investing in paper assets like stocks, bonds, mutual funds, ETFs, that kind of stuff.
Yes.
So for some of those types of investors, they have a hard time bridging that gap between understanding all the benefits of real estate and seeing it as an investment. From where we stand, my company, my team, and I, we look at real estate as a true investment, and we look at everything else as the quote unquote alternative. When you listen to CNBC and the mainstream media, they're always talking about the paper assets, the stock market, and all that kind of stuff.
Right.
And then they refer to real estate and other things like that as alternative. For me, it's completely the other way around. And the reason for that is the answer to your question. When you look at real estate, and this is easy to understand for anybody, we're talking about a hard asset, not a paper asset. It is truly made of sticks, bricks, copper, and concrete. It sits there on land, and land has always been there and always will be there, short of global warming flooding the planet, right? But it's essentially a hard asset. It's immovable, and it has real tangible value because it's not just the fact that it's there, but it provides utility, a place to live. It provides shelter for people. And so because of that, we have a productive asset that creates wealth and income. So now let me explain that part, because that's truly the answer to your question.
Sure.
When you have a paper asset, you essentially have something that is valued by the market at a certain price. And the emphasis is on the word price. That could literally change from day to day, hour to hour, minute to minute, depending on the volatility of the market and how liquid it is. With real estate, we have a very stable, small, low fluctuating type of asset. So when you look at it from a price perspective, that changes slowly over time, but over time it does increase because real estate keeps up more or less with the real rate of inflation, not the nominal rate, but the real rate of inflation. And it has to do that because it's made out of commodities that sit on dirt, land. So from a capital gains perspective, which your investors are familiar with, you measure that in terms of the price of the stock or the asset that you're buying. We measure it in terms of the price or the market value of that property, which goes up in time because of inflation, because of the fact that commodities get more expensive over time. Secondly, and this is a big differentiating factor, and this is so important for your audience to understand, as a general rule, and for the most part, you know that all the paper assets that you guys invest in, whether you're a day trader, a swing trader, a long-term buy and hold investor, you're speculating on stocks or this or that, those generally don't produce income. You don't have monthly cash flow. And that's a huge differentiator, because when you own income real estate and you have a tenant that's paying rent every month, they're essentially buying that asset for you. When you take that income and you deduct all the expenses to carry the property and fund the future maintenance and repairs, what's left over is called cash flow. It's the net income from that property. So you have this beautiful thing called cash flow. Now, guess what? If you have enough of those, you've created enough passive income to create financial independence for yourself. And if you do that long enough and you have a stable or large enough base, you are financially free. And you do that because you have income. Now, so you've got the income, you've got a stable hard asset, you've got appreciation over time because of inflation, And you also have something that's we call amortization. When your tenant is paying off the mortgage on that property for you,
Yes.
what's effectively doing is it's creating a little bit of wealth every single month, more and more and more as the months and years go by. Well, that mortgage pay down each month is a little bit more equity in the property, and that increasing equity adds to your overall net worth. So you're becoming wealthier every month by so much per property for the number of properties you have in your portfolio. So we've got income, we've got a hard asset, we've got amortization of the loan, which increases your wealth, we've got the appreciation over time, which keeps up with inflation. And last but not, well, actually, I'm going to add two. One is something beautiful, which is depreciation. You can't do this with stocks, as far as I know. Maybe there are specialty types of stocks where you can do this, but the tax benefits that you have with income producing real estate is phenomenal. The IRS flat out tells you that you can depreciate the infrastructure, basically the building on the land, over 27 and a half years. And guess what? You don't have to spend a single penny to get that depreciation, to get that tax write-off. It's called a zero cost tax deduction. You get the tax deduction without having to do anything for it. And last but not least, and this is huge, is real estate gives you, the investor, the ability to leverage your investment capital 5-to-1, which means that if I have $20,000, I can buy $20,000 worth of Microsoft stock or Netflix or whatever the case is, or a mining stock.
Sure.
Or I can borrow, $80,000 to add to my $20,000 and purchase and control a $100,000 rental property, let's say in the Midwest or in the South or in the Southeast, places we operate, and have 100% of the benefits of that $100,000 property, 100% of the control, 100% of the ownership, but I only had to put 20% of it down. I borrowed the other 80% at a low fixed rate that's locked in for 30 years, and my tenant is paying it off for me. So again, I leverage my return because I can only in quotes, only put down 20% or as little as 20% on an investment property. So those are the 5 or 6 big things when it comes to investment real estate, comparing it to equities and paper assets.
Now, those are incredible attributes to get involved into real estate, but there's probably a lot of our audience members, especially maybe they may be younger and they may be concerned about because to them perhaps the real estate sounds like very high level type of platform. But one of the specialties that that you market is that Norada Real Estate specializes in turnkey investments, which I think would provide a certain measure of confidence for those who want to take advantage of your services. Could you, just so that we're on the same page, could you help define what you mean by turnkey?
Yeah, brilliant question, because it's a term that's used a fair amount in the circles, investment in real estate investor circles. But even there, a lot of people still don't really fully understand what the definition of turnkey means, because it's different things to different people.
Sure.
For some people, it means just finding a rentable property or a property on the MLS that's been rented, and it's really nothing more than that. It's rent ready or rented. It's leased and maybe under management, and that's about it. You know, there may be issues with the property. It may be in a bad neighborhood. There may be deferred maintenance or capital expenditures that are coming up. So, you know, we don't carry that type of property. Once in a while, we have something that is passable and it's a good rent-ready property. But for the most part, the only thing we offer are what we call turnkey cash-flowing rental properties. These are single-family homes, duplexes and fourplexes that are in around 22 different markets around the United States. And these are markets that provide real rates of return from income to appreciation. Now, to answer your question about what is turnkey, here's how we define it. Because again, you know, it's defined a little differently by different people.
Sure.
But for us, it's essentially this minimum standard. It's an investment property that's in a good market. We can define that later. A good market in a good neighborhood. It is tenant occupied. It is professionally managed. It is cash flow positive from the month you buy it. It is It has no deferred maintenance. And along with the services that we provide, you have the entire team that you need to operate and build your real estate portfolio, or what some people call a real estate empire. But essentially, it's owning a portfolio of rental properties that are well located, cash flow positive, professionally managed, and just generate income month after month.
I see. And going along that theme, on your website, you mentioned that your team is market agnostic. Essentially, you go where the fundamentals take you, and you're not chasing whatever fads that may be impacting the markets. But to That's a slightly different approach to the lay investor, where they're merely looking at the price tag. Is it fair to say that using price alone can be a deceptive indicator?
Yeah, very deceptive, because you can't judge a rental property and whether it's good or bad or productive or not just by price alone. That is not only one dimensional, but it's extremely myopic. It's no different than me going to you and saying, here, take a look at this NASDAQ stock or this mining stock, and saying, what do you think of it? All I know is it's $5 a share.
Yeah.
But what is it a good deal? I mean, you can't answer that question. What's the story? Who's the management team? What are the fundamentals? What are the technicals? You need to get into all the aspects of it to be able to answer a question intelligently of, is that a good deal or is that not a good deal? So I don't know if I'm starting to answer your question, but you can't judge based on price alone. You have to look at the market, the location or neighborhood it's in, the cash flow analysis. What's the income? What are the expenses? What does that leave over every month for me? The condition of the property, which for us is obviously in like new condition, or new construction, which would be obviously new. Those are some of the things you have to look at. We make that information freely available, mostly on our website. The rest of it you get from your investment counselor. So by the time you have one or two phone calls, you've got the whole story and the complete picture of the different markets and properties as investment options available to you. And nothing we do is magic. We're just doing the due diligence for you. You could do this on your own. The information is available online.
Right. We know that certain real estate markets, like Detroit, they fall on the extreme end of the real estate scale. But on the other end, we have high-profile markets like San Francisco or Seattle that, right now they seemingly have no limits. Now, when we in talking about price, are these markets just simply too expensive to make economic sense?
Well, they are. You look at a lot of the coastal markets in the United States, and a lot of them are very overpriced, and many of them are what we refer to as bubble markets, because they get to a point where they become so unaffordable, and they appreciate so fast that they hit a top, they turn around and they depreciate very quickly as well, and maybe not to the same level as they were before, but it has happened. But they're more like a roller coaster in terms of price appreciation and depreciation. So they're volatile markets, and the fact that they are expensive means that they are not only overpriced, but the other problem is that something we call a rent to value ratio, which is the ratio of what is that price of that property when you buy it versus the monthly rent. We like to see that number around 1%, ideally. It could be a little more, it could be a little less. 1% is kind of that target or that sweet spot. Okay. The problem with San Diego and the coastal markets on both sides of the country is they get to a point where affordability is so low because prices are so high that rent to price ratio is around 0.4%, maybe a little more, a little less, but it's really low. And that means it doesn't make sense as an investment because, number one, they're pricey, they're expensive, and you have downside risk. Number two, your down payment is going to be pretty high to come in and buy an $800,000, $1 million property that you're only going to be able to rent for $3,500, maybe $4,000 a month. And if you're able to do that, you don't really get a good cash on cash return. Your rates of return are diminished. So, you may not even have a positive cash flow without putting in a larger down payment. Well, why do you want to do that? If you have to put down $200,000, $300,000 or more on that property, why not take that 200,000 or 300,000 and get yourself 8 to 12 single-family homes in very stable, more linear type markets instead of cyclical markets, have far more cash flow, far more stability, and still have, over the long term, just as good of an appreciation potential as you see in these cyclical markets. So it doesn't play out for most people. In fact, very rarely does it play out for these expensive markets to be trying to invest in them right now. The people you find buying property now in these expensive markets are people who think they're investors, and I say that in air quotes,
Okay.
but they're really speculators. They are hoping and gambling on the market in the hopes that the price goes up, because they will say that my property is appreciated and therefore I've made a return and I'm a successful real estate investor. Well, the reality is that's not a realized return. It's on paper. It's only in value has that number changed, or in price has that number changed. But until you actually pull that equity out, you haven't really generated a real rate of return. It's only on paper. It's not realized. So values go up, values go down. Whatever you've gained, you can stand to lose. But if you don't have cash flow in the interim, you don't have the glue that holds your deal together to maintain, preserve, and increase that equity over time. So it's important to have cash flow and equity, but cash flow comes first because that's your immediate rate of return, and it's what I call the glue holding your deal together. The equity will come, the equity will happen, but why not have both instead of being a speculator hoping on the appreciation in a pricey market?
Sure. And I don't necessarily disagree with you on that point, but there are some proponents of these coastal markets that would argue that these coastal markets tend to have some of the best paying jobs. But is that not enough to overturn these discrepant economic metrics that you just mentioned?
It's not, and here's why.
Okay.
It's not how much you make, it's how much you can afford to pay.
Yeah.
So there's no question that the incomes in San Jose and San Francisco are much higher than the national average and most other markets.
Sure.
But their real estate values, their real estate prices, and even the rents in that market are considerably higher than the rest of the country too.
Mm-hmm.
So in order to be able to afford to live there, you don't have a choice but to make a lot more than the rest of the country. So just because you can afford to live there doesn't make it a good market to invest in or live in or rent in. People who live there because they have employment there. But if real estate was more expensive and they couldn't afford to live there, I'll guarantee you that they probably would move. You know, if they can't find a job to afford to live there, they don't have a choice but to move out further from the core of the city or where their jobs are located. And you keep moving out further and further and further till you get to the point where you can afford it. It's just the way it works. There's concentric rings from the core being the most expensive on further and further out, it becomes less and less expensive, both real estate and rents. So it's not, income plays a role and it is important, but it's not the only factor. At the end of the day is how much does the housing cost relative to how much I make. If it's more than 40% of what you're making, that's a very expensive market.
Yes, absolutely. Shifting gears a little bit, you have a wealth of opportunities listed on your website. However, many people are just gun shy, particularly after the 2008 financial crisis. We saw many markets drop 50%. And just to juxtapose that with the point that your company was one of the very few real estate investment firms that successfully navigated this bearish time period. I was wondering, what guidance can you provide people who are still worried about another recession or market crash?
Well, first of all, a recession is inevitable. It's we've had, I think, now the second longest economic expansion in U.S. history.
Yes.
And I'm not saying that's good or bad. It is what it is, and that's fine. But because of the financial system and the economic system we have, because of the Federal Reserve, because of many different things, we have cyclical economic cycles. So the question of whether we're going to have a recession or not is not a matter of if, it's a matter of when recession will play out, is really a function of many different things that play into global economics, macroeconomics, all kinds of things like that. So recessions will happen. We just go through these cycles. In terms of the real estate, every market is local, and this is an important fact for your listeners to understand. When you listen to the media and you read the newspaper, you always read about housing and real estate as if it's this one big nebulous blob
Right.
that is, something that's in the country of the United States. Well, that's not exactly true. The reality is, as you know, living in San Diego, that what happens in San Diego is certainly different than what happens in Detroit, Michigan, which is certainly different
Sure.
than what happens in like Galveston, Texas.
Yeah.
So you have to look at real estate as being hyper local. It really is down to, in some cases, the core of a city surrounded by different rings and suburbs and submarkets and then neighborhoods. It really is that granular. In fact, it can be street by street. What happens in one location within a neighborhood can be different than what happens in another location. So understanding that, you realize there's no such thing as a national real estate market, and you got to stop talking about real estate in those types of terms. But when you get back to your question about real estate cycles, yes, they do happen, and they do happen at different levels. Of course, you could look at it nationally, but they happen at a local level. So as a real estate investor, I actually like when there are real estate corrections, or call them a crash, because that provides all kinds of great opportunity when prices come down, because now I can buy more in those markets that I want to invest in, the ones that make sense, remember, not just any market. So I can buy more and I can build a larger portfolio faster with greater cash flow. And that's what the smart people did after 2008. You have to understand that there were a lot of people who ran away scared, but there were a lot of people who sat back and were drooling, licking their chops, saying, this is great. I can't wait for these properties to come to market through foreclosures and whatever else, because I can pick them up at 40, 50, 60 cents on the dollar. And again, I'm not talking about a speculator's game. I'm not talking about appreciation. I'm just saying that they're buying at a huge discount. Those same people are still looking at what is the monthly rent relative to the purchase price, that rent to price or rent to value ratio, because they know if they can buy at a greater discount and that market still has strong rents, like rental amounts for that same 3-bedroom, 2-bath or whatever it is, they're going to get greater cash flow, get greater rates of return, like always double-digit rates of return. And on top of that, they're positioned in these different market cycles to benefit from the return of that market back to its historic norm, its historic median, and then beyond, which is exactly what we saw happen in most of these markets around the country in 2012. So we had this decline from 2006 to 2006 through 2008 in markets that kind of bottomed out in 2012. And a lot of people started buying in even earlier than that, like in 2009, 2010. But you hit the bottom in most of these markets in 2012, 2013, and it did nothing but just solidify and appreciate from that point forward. So now you had cash flow and you were building wealth at a faster pace than most other people do over a long-term historic average. And so that, you're not out there to try and time the market, but there is an element of timing. And so buying in the right markets at the right time certainly helps in building your wealth.
Sure. Marco, you started real estate investing at a very young age. You bought your first investment property at 18. Right now, though, the economy, the markets have changed dramatically for young investors. Many students, of course, are saddled with debt and they have other challenges. Is real estate still a viable platform for young investors today?
Real estate has always been a viable investment class to invest in, and always will be. For as long as we humans need a place to live and a place to work, Real estate will always be a solid investment if you buy the right way. You have to be smart and prudent about it. You just can't be a speculator, like I was saying before.
Yeah.
You have to obviously think logically, not emotionally, and think prudently and rationally about your decisions. But real estate will always be a sound, smart investment. Why? Because we all need a place to live, and we all need a place to work, and we all need a place to go and shop. Less the stuff on Amazon, of course, but we all need a place to go and shop, right? You can't get your haircut on Amazon, right? You can't. You still need to drive somewhere to get your haircut.
Yeah, not yet, but yeah.
Not yet, exactly. Maybe they'll have a drone fly over and lower and start snipping your hair.
Exactly.
There's an idea.
Yeah.
But yeah, no, real estate will always be around, and real estate will always be a good investment. It really comes down to the fundamentals and the numbers, because if those things fall in line, then you've made a sound investment decision.
As someone who's been living in California most of my life, I'm always under the assumption that everybody wants to move here, especially in Southern California. But when I looked at your website, I learned something new, which is that I'm seeing so much diversity in terms of what you consider as high cash flow markets. I was wondering, can we expect this regional diversity to continue broadening out?
Are you talking about the cash flow, or are you talking about just the growth of populations? Sorry.
I'm just referring generally to the demand within these markets because, for example, you placed opportunities in areas such as Birmingham, Alabama, or Boise, Idaho, and these are regions that I would say most Californians don't even think about as being hot real estate markets. And I was wondering, will we see a shift more towards these what we might perceive as underserved areas as opposed to everybody moving to the coastal regions?
Well, here's the thing. We can talk about this from an investment perspective or a residency perspective. Where you choose to live. I have this saying. I've trademarked the saying: live where you want, invest where it makes sense. Okay?
Yeah.
It's on every page of my website. And the message there is this: you can live anywhere you want. You live where you want to live, whether it's because of work or because you love the ocean, you love this or you love that, the mountains, right? You choose your residency. But when it comes to investing, you have to invest like an investor. You have to look at the numbers and make sure that you're getting a rate of return and you've got a sound investment. The United States is made up of over 400 MSAs, metropolitan statistical areas. So for people who live on the coastal markets, and for a lot of people that I know and that I've known that live in California, we tend to live in a bubble here. And for many of us, we live inside a bubble in a bubble. And we really don't know what is going on real estate wise outside of our county, let alone the state.
Sure.
But the reality is that we are more of an anomaly here because that the property values are so high. If you look at most of the United States, a median home in a lot of the markets is between $200,000 and $300,000, a median home, and that's a lot of home, and that's on a good sized lot. A lot of the properties our investors are purchasing, or a lot of our clients invest in through us, are typically between 100 and 150, maybe 200,000, but 100 to 170,000 for a 3-bedroom single-family detached home. And then, of course, there are duplexes and fourplexes as well. But you look at those properties and you move that property to a comparable neighborhood here in California, that now all of a sudden you have a $700,000 to $1 million property. So that's how much of a price difference there is, but it's the same square footage, same property. So the issue is that we living in a bubble here see these high values because, one, tremendous amount of government regulation. It's difficult to build and it takes a long time. Limited land. So when you have limited supply of something, it pushes prices up. You still have, even though there's a lot of people moving out of the state of California, you still have a lot of people moving in because of work and because of the climate and because of the ocean and whatever else. It's a lifestyle thing, or it has to do with your career, your profession.
Right.
So we still have a lot of people living here. And because of that, And coupled with all that, we have a shortage of housing. In fact, this is a big problem across the country. We are perpetually behind the curve in terms of housing or housing starts that we need to supply the population growth that we have, both immigration-wise and organic. So we always have a shortage of housing. So again, when you have short supply, you're going to push up demand, and that pushes the prices up. It's just, supply and demand, the law of economics. So that's what you're seeing. But when you take yourself out of that bubble and you look at the rest of the country and look at what's really the norm, you'll realize that you are not the norm here. Mm. The norm is middle America, $200,000-$300,000 homes or less, 150, 200,000. And these are great properties because they're typically in nice neighborhoods like B plus, sometimes A minus neighborhoods. Sure. And they rent for about 1% of that price per month. So if I buy a $150,000 single family home in a nice neighborhood, I'm renting that thing out for about $1,500 a month. So do the math. I have some pretty damn good cash flow considering I'm only putting 20% down, and I can, pocket $300-$400 a month net income off of that property. And if I do that times 10, well, guess what? Now, I could probably pay my living costs here in California, right? I pay my rent, groceries. Okay, so now I've achieved financial independence. Now, what if I do that, if I double down on that, right? Mm-hmm. We help clients get to that maybe 15, 20 property mark. Well, now they should be financially independent, like already by that point, but they could be financially free because now they've got that buffer in there.
Wow. I'd love to pick your brain more about this fascinating topic, but unfortunately, we're out of time. But before we leave, could you tell us where our audience could go to learn more about your work?
Yeah, so we have two websites, and there's tons of free content and information and downloadable material on those two websites. The property website is Norada Real Estate, Norada, noradarealestate.com. The other website is the sister website, and they link to each other, by the way. It's the home of our podcast, and it's named after the podcast, so passiverealestateinvesting.com. Passiverealestateinvesting.com is the home of the Passive Real Estate Investing website or podcast.
I see. Marco, thank you so much for sharing your insights with Smart Money Results.
Josh, it's been my pleasure. Thank you so much.
Thank you.